Last time one time I messed up not recording, so let's see. Okay, can everybody see that okay?
Yeah.
Okay, excellent. Well, good afternoon. Happy Financial Fitness Friday, even on a Thursday. Thought we quickly, here's the quick disclaimer. Most of you, there's a couple new faces here, but notice this is not specific recommendations. This is meant to be a discussion and hopefully educational. But if you have specific questions, you should see a financial advisor, fiduciary. And I do, so that people can see these after the fact, I post these on YouTube, and I want to make sure if I can get a thumbs up from everybody that they agree, they're okay with actually posting these to, obviously there's not going to be any payments. This is just that people can view them after the fact. Okay. And let's see, I didn't see Brittany, Joe, or Sandra there. Excellent. And if anybody would actually prefer to be on video, it helps me out because I can see your expressions and whether it's making sense or it's not, or I'm boring you, etc. So, but if not, that's fine as well. I guess today's discussion, as mentioned, is excellent. Thanks, Brittany. Is about inflation, recession, and bear markets, and what do you do? Bottom line, we're in very uncertain time right now in the economy and the markets, and I think this is an important topic because we're all emotional humans and can end up making decisions that are not in our best long-term interest that could have significant effects. And then hopefully by the end of this, I don't have all the answers, but you'll feel a little more comfortable with the current situation and learn more about what you can do now and then down the road. Any questions before we get rolling? Okay, and just ask questions as they come. Here's the agenda. We'll kind of talk about all of these: inflation, recession, and bear markets. They kind of all go together. But then I'm going to go into accumulation versus drawdown portfolios, and then some specific questions that came up. Unfortunately, Shama's not here. She asked for the recording, but she has a family emergency and won't be able to attend. But she had several questions specifically on this. Okay, first we'll just go into what is inflation. I think people know the general definition, but then why, what are the different types, and then what causes inflation? We haven't had inflation. This is, heck, I think everybody here, nobody's ever dealt with real inflation. It's only our parents back in the 70s when, which is what we've hit. We've hit for, the first time 40-year records in inflation. And so we'll quickly kind of go into what these causes are, and then hopefully what we can somewhat do about it. Here's other types of terms, inflationary terms. Stagflation is really scary. That persistent high inflation with high unemployment, which ultimately, when you have a lot of inflation that's persistent, high inflation, that usually leads to more unemployment. Right now, we're at extremely low, 3.5% unemployment rate in July. It's very low, but some of you might have seen there are some layoffs that are happening in some businesses, but it's an interesting, fortunately there's no stagflation right now. Shrinkflation, that I think everybody's seen. Heck, you see it at the restaurants all the time. All of a sudden your portion sizes are much smaller, but all these companies do that, whether it's Cokes or, chips or whatever. It's all of a sudden there's fewer ounces and you're paying the same, or even paying a little more. And it's a sneaky way, but it's very rampant throughout. And then there's kind of this misunderstanding of disinflation versus deflation. Disinflation is what, from last month to this month, we're currently in. It went from 9.1% inflation year over year to 8.5%. So it's a slowing in the rate of inflation. Hopefully that continues at a much better number. Deflation, on the other hand, is a decrease in the overall price of goods and services, which reminds me, I had a poll I'm going to quickly send up for everybody as we're just getting started. Okay, do you guys all see the poll? It's just 5 quick questions.
Yep.
Okay. The first couple, it was just a reminder. I was talking with somebody about it, and the fact of, hey, check and benefit. And by the way, of course, all of these are anonymous. I don't see whose answers what, but really, it's just, you know, beneficiaries. That's something people. It's something easy to overlook. And then I noticed on the recordings, it doesn't show up. I don't know if people know how to have it show up actually when I launch the poll, you know, the results, that you can see it on the recording. But since it doesn't, I'm going to read off the questions and the answers. And you look like people are okay. Okay, anybody need more time? I think everybody's good. Okay, I'm going to end the poll now and share the results. Okay. Okay, can everybody see that? Okay, the beneficiary's time of death certificate on all accounts. You need to make sure you do that so that things don't go into probate and it takes months for people to get money. It just came up in a discussion I had with somebody, and it's worth checking, and then recheck those every year. Once a year, just do it. Who knows, like life circumstances change. People get married and they still have like their siblings or parents as beneficiaries instead of their spouse, or I mean, on a more negative note, unfortunately, divorce. Then you could, that could cause a change in beneficiaries. It's happened before. So just something important. So it looks like 5 out of 8, have done know theirs, and 6 out of 8. Then the second question is, have you reviewed your beneficiaries this year, and do you review them annually? 6 out of 8 said yes. So hopefully the other 2 will start doing that now. Third question was, which is worse, high inflation or recession? 6 out of 8 said high inflation. I'd have to agree with that, but we'll go into that. And 2 out of 8 said recession. Which is worse, inflation or deflation? This was a little more spread. 3 people said, 3 out of 8 said inflation's worse. 4 out of 8 said deflation's worse. And since deflation's kind of weird, it's like, what the heck is inflation? One person said. Personally, I think deflation, long-term deflation, is more damaging than actually inflation, and we'll go into that. Okay. And hide that. Okay. Okay. So, see, is it not advancing? Okay. Here's quickly the types of inflation that mentioned: demand pull, cost push, and built-in. Demand pull, hey, we've got current, what we're doing right now, too much demand for goods and services and not enough quantity with the supply chain disruptions. We're currently in that state right now. And also, you think about airlines, everything else, vacations, super expensive because of COVID. Cost push, that's when production costs increase. That also kind of includes labor, which is also built-in, but these are like producers, their cost of commodities, et cetera. So how much it costs to build these goods goes up, so then they pass on to the customer. And then third, built-in, which is kind of, we always have. That's why, and the government, why I said also deflation is worse than inflation. The government wants about 2% inflation because it kind of stimulates the economy. It doesn't keep people from not spending money. Whereas deflation, which is, we've only had really one significant deflationary period in the US, which was following the Great Depression. And there, people just won't spend money. And so businesses, have to drop prices. They end up going out of business, and it's just this terrible cycle. And the economy just keeps slowing down and slowing down and slowing down. It sounds initially good, the idea of prices going down, but actually a little bit of inflation is good to stimulate the economy. But when it gets high, like it has now, and I'd say it was expected with all that we did, it's the problem. So we're in like the trifecta of inflation. All the different types are hitting us right now. With the great resignation, there's wages are going up as well, which is good, but we'll see how that can be a spiral that can be very dangerous, which is was in the 70s. Okay, did we cause this inflation? Yeah, I mean, COVID had definitely impacted, but here's the reason why. Kind of like it goes into what the causes of inflation. So monetary and fiscal policy, those to me I've always found kind of confusing, like which is what's the Federal Reserve, what's Congress, what's legislative. Monetary I think of as money, and that's the Federal Reserve, and they've got different levers they can pull to really combat their mission is to minimize inflation and maximize kind of employment, so to keep the economy going in a good direction. But their monetary policy, can lead to it is too much money supply. They put $5.2 trillion of stimulus in the market. So check, that was done. Fiscal policy, higher borrowing. Yep, that happened as well. Demand pull. I mean, these are a lot, all related to COVID, but supply chain issues. We have fewer goods out there for people that are wanting them. Initially, this didn't happen right during COVID, right? Because people weren't buying stuff. The main thing they were doing is buying home gym stuff, it seemed like. And but now there's such a pent up demand that there's still just not enough goods for the amount of things. Cost push, the goods, it's commodities prices have went skyrocketed, energy, everything else. That caused a lot of the cost push. And then just we're also talking about labor, the fact of the Great Recession, and people businesses having to increase wages just to get people to do the job has also increased there. One of the concerns, I'm not going to go into exchange rates, but one of the concerns is this is a longer term thing, is the dollar has been the global standard, and there's a countries trying to get rid of that. What I was saying about that inflation spiral, though, and this would happen really significantly in the 70s, and part of that, what made that spiral so bad was actually the number of unions back then. It might sound crazy, but that's what they had such a larger percentage of the population, working population, and they had such pull that they would constantly be ramping up wages, which then companies had to raise prices, and it's just an ugly cycle that continued until a new Federal Reserve actually went and bumped interest rates super high and drove it right into a recession. But it ended up getting us out of the inflation, which was actually, in my opinion, is worse. You just can't compete with rapid, persistent, high inflation. How do we get out of this? Like I said, the Federal Reserve does monetary policy, and they've got certain levers that they do. The two key ones that they mainly work on are raising interest rates. When they do that, it's bad for borrowers, it's good for savers, but it's tough for business, and it slows if you raise interest rates enough. Just like you're seeing in the mortgage market, that dried up, like home sales dried up completely as we went from these super low interest rates to much higher. But same with businesses. One of the significant things is now all of a sudden short-term business loans are much more expensive, and so businesses constantly keep a deficit and just keep re-upping these loans. But now when they get higher, now they can't invest as much, and so it forces a slowdown to the economy, which ultimately typically leads to a recession. Right now, they're really the rates, how they went up, shouldn't actually slow down the economy. I mean, that's how low we were at zero, basically. So they're just getting back to, I'd say, kind of almost normal rate. which shouldn't really cause a recession yet, but it does slow. It's already starting to slow things down. They're trying to do it, say, a soft landing, which I don't see how you can typically do that. Usually, a soft landing results in by dropping interest rates a little bit. So, and we'll see. And the question is, are we already in a recession? Controlling the money supply. This is what they've started doing more of too. Initially, when COVID happened with 2008, they buy up a bunch of securities, all those mortgage-backed securities back in 2008. Government started buying all that, and it provides a lot more money, in the economy as well. So when they want to tighten it, they'll sell all these securities, and they're starting to do that. And unlike even in 2008, the Fed started buying securities we'd never seen before. Them buying. It gets kind of scary what they'll get into. But and then there's fiscal policy, and that's Congress. Have you guys heard of the Inflation Reduction Act that was just passed? Anybody know what that actually does? What the Inflation Reduction Act is about?
I do not.
Matt, you do? Do you know? You want to say anything about it?
All I can say is I've heard of it, but I'm not familiar with its specific content.
Okay, to me, it's a stupid name for something that has nothing to do with inflation. Last year they tried to pass the Build Back Better plan, which I'm glad they didn't, because I was getting rid of the mega backdoor Roth, the backdoor Roth, all sorts of things. And this is really a slimmed down Build Back Better. And I guess the government just thinks we're that stupid as an economy that, as the public, that just a name means it's going to fight inflation. It's not. Here's what it does. It does a minimum 15% corporate tax. Okay, that might help slow down the economy, because these small, tiny businesses are going to have much more expenses now. Prescription drug price reform. Okay, that's good, but that's not really what's hitting us in terms of inflation right now. IRS tax enforcement. Oh, so they're going to spend $80 billion more to increase IRS. That doesn't help inflation. Affordable Care Act subsidy extension. Okay, that it's an extension. It doesn't really get that. And then there's energy security and climate change investment. The more spending, more deficit spending. None of that has to do with cutting, attacking inflation and getting the cost of goods and services to stop going up. Anybody have any questions there? Sorry, that's just I get annoyed with these words that when they're trying to lie to us, basically, and think that they try to fool us. I don't like them thinking we're that stupid.
Doesn't some of that go towards the climate, helping the climate change and renewable energy and stuff like that?
Yeah, it does, but that's not going to help inflation either, right? I mean, maybe a little bit long term, but yeah, sorry, that was what I said at the end. Energy security and climate change investment. So, I don't know. Germany's been dealing with this, trying to do this huge conversion for the last 10 years to green energy, and it's not worked, unfortunately. And I'm a big believer we need to get better energy sources, et cetera. But this isn't good. The idea that this is an Inflation Reduction Act, it's not. It's just promoting what they've already wanted to do previously, which was Build Back Better, and other government initiatives they've always wanted to do that have nothing to do with inflation. That makes sense, Jonathan? Or that's my opinion.
No, I agree.
Okay. Anybody else have any questions there? Or? Okay. Okay. So now talking about inflation hedges. These are kind of the standard things that you've probably heard about as inflation hedges. Gold. And I put down their cryptos and NFTs as well, because they're a similar speculation. They're, they don't really produce anything. It's just a store of value, and whether people will want to agree more with that. Commodities, those are a very volatile thing, but when supply chains get shortened, commodity prices, raw materials, energy, all that shoots up. And that is, but if you try to jump in that right now, you've already missed it. So, and it's super volatile. It goes up 50%, goes off down 50%. Stocks, real estate, California, super expensive. So, I know a lot of people don't own their own home, but there are REITs you can buy as well that basically, help invest in real estate if you don't have your own, home purchases. And then there are bonds and tips. Tips come in and they just haven't worked, really. These treasury inflation protected securities. If you look at their track record, they just haven't done well. And we'll go into the kind of why that is, because they're bonds that are sold on the market. And so they're impacted by interest rate changes and, consumer demand. So, and then there's I bonds. Is everybody familiar with I bonds? Because we'll get into that. I'm going to compare tips and I bonds and what I think about it. But tips just haven't been effective. When they needed them, we've needed it to work. They haven't. So I'm not a big fan myself. But you see stocks by this this graph. Stocks is really where you're best in inflation hedges and real estate, I'd say, as well. It doesn't show that, it doesn't have real estate, but we'll get into that. But overall, through this shows from 1802 to 2016, stocks made a real rate of return of 6.7%. I've always heard 7%. That's above inflation. So that's what you need, is to beat inflation. Gold holds its value. It doesn't. Is it part of a risk parity portfolio down the road? Yeah, I do. I probably do agree with that. But we'll get into that. But for young investors, I wouldn't worry. I wouldn't worry about any of this. I wouldn't change anything. Don't go change your allocation just because doing nothing is usually better. And for young people, I'm all about just as many, getting stocks, meaning index funds in general, low cost, broad-based index funds. So here's I bonds versus tips. So here's their performance. We've had the worst inflation, right? In 40 years. And look at their year-to-date performance, minus 6.37%. Is that what you want in an inflation-protected security? It's failed to do its job. I bonds, on the other hand, these are really more of a cash equivalent. How I like to think of using I bonds is, as you're getting closer to retirement, using these as your cash equivalent that's inflation protected and interest rate is not impacted by interest rate. So we'll go into the bond ladder and how those change as interest rates go up and down. But the I bonds have two sets of interest rates, and the inflation is adjusted every 6 months. There's a fixed rate, which actually back, I think 20 years ago, actually had like a 3% fixed rate and an inflation adjustment rate. But they changed that and got rid of the fixed down to 0. And so the overall rate that you get is the sum of those two, which is really just the inflation adjusted rate. So right now, it's in every 6 months, it resets based on the CPI, I think it's CPIW, the Consumer Price Index. And it was in May, it was 9.62%. And that goes on for 6 months. And then in November, they're expecting it actually to be a little 10% or more. For those 6 months. You get limited, you can only put 10K a year, and then if you have a tax refund. But it's never going to beat inflation. It's just going to ensure your cash does go with inflation, but you're going to still pay taxes, unfortunately, on those gains, unless it's used for like certain little things. But like I said, this is when you are getting close to retirement and you want that larger cash equivalent bucket so that you don't get hurt by a down market right as you retire. This is where a perfect thing, I think, for I bonds is. Where you could do, several years before you're getting ready to retire, start bringing these in, and then you have that as an extra source for the first few years to ride out any bear markets like we're having right now. Okay, any questions on those? Okay, whoops, you guys probably saw that too quick. Gonna ask. So stocks and real estate. This a lot of times people think that how the housing market, real estate has a better rate of return than stocks, which is not normally true. But they are both a great way to wealth, and real estate has certain advantages, tax advantages, and other things that you don't get with stock. Plus, it's leveraged, which means you put in a small, even if you put 20% down, and you've got 80% levered, as that value goes up, it's on such a smaller amount of the money that you've invested, whereas the stock, it's every dollar you put in, right? That whatever that return is. So real estate, you're talking though, it's a fraction. Leverage helps that 5.3%, 5.4% annualized rate to go upwards of like 20% because you're levered if you went and sold. And there's a number of great things, but about home ownership. But why mention this is look at the significant difference though, just in cash. You can, how much that difference in the S&P 500, those several percentage per year over a long time, it's a significant amount. But why I do this is because I know so many people wanting to buy a home, and it's been crazy inflated. Normally in a decade, I think they were saying it's about 45-49% increase in home prices over a 10-year decade. So that's pretty redundant. Over a decade. I think in the 2000s, it was, they're saying the 90s, 2000s, 2010s, it was between 45 and 49%. But from 2020 to 2022, it was like 35 to 39% already. So nearly the whole decade. I mean, this just cannot continue. And I put up this book, Quit Like a Millionaire, just as it does a good rent versus buy argument for this was an early retiree, and they don't have any home, and so they don't have any mortgage, they don't have any of those concerns, and they just go live wherever they want and run off the local economy. And it's a pretty interesting book though. But there's, I know everybody, it's kind of the American dream, but just don't feel bad. Southern California is insane, and don't feel like you have to have a home already. So any questions there? Okay, so how do you deal with inflation? First thing is, as you should already have done, hopefully, is have all your investing automated. That way you've paid yourself first, and you're saving towards your future, so that it kind of forces a limit on your budget, I guess. Right now, in my opinion, delay large purchases. If you don't need to buy a car, which is insane how expensive they've been, don't. When I think of in a couple of years, the number of companies that are going, all on electric, we're going to have a plethora of good choices, fuel efficient, fully electric, or great hybrid, and the prices will be much more reasonable, and used cars will start to depreciate again as they were. We're in just a really weird time. Also, these interest rates and where the home values are right now, probably wait on that if you can. I know that's just tough, but I don't see how this can appreciate. And I've already seen you're starting to see nobody's putting offers down, and people are starting to drop the prices. So there's not going to be a crash if anybody thinks that. In my opinion, there's just too short of an inventory to have like a 2008. Where they said there's about a 1.5 to 2 million too few of homes for the amount of demand there is out there. So it's not going to be a crash, but it might dip down a little bit and level out. And we'll see what happens then with interest rates. But we've needed, it's been way too much of an increase. Certain things sound silly, but hey, as things get more expensive, start tightening it up. Brown bagging, cooking more of your meals yourself. And actually, despite all this inflation, consumer electronics, that's one area where the chip shortage already caught up, and they're actually a great deal on from TVs to laptops, things like that. It's actually a good deal. So you just got to pick and choose the right things if you can. Any questions, or anybody have any thoughts of other ways that they think, how to currently combat? Because I'm going to put up a few things for all these: recession, inflation, bear markets. There's many similar things we can do, but figured. Anybody have any other thoughts?
Hey, Alan, could you try and just explain again why the reason that consumer electronics are cheaper than everything else by inflation?
So actually, stores have, so there's a huge chip shortage, right? Which has been causing much. That's what's caused all the problems with the cars, the lack of inventory of cars. Well, they've at least on the electronic side, they've caught up much better than other industries, and so now they have this surplus of inventory of consumer electronics. So that's where you can get deals, and they're trying to sell off their stuff as we're rolling into 2023 products are coming online right now. So they're trying to get rid of their old stuff as quickly as they can and get inventory off their books. Does that make sense? Okay. Are we in a recession? Anybody have any thoughts?
I think we technically are. The GDP over the last two quarters in a row, right, is negative.
Yep, that's perfect.
The widely acceptable definition of a recession, I guess.
That's it's like you had looked at the slide already. By the normal definition, we're in a recession. I mean, there's been the last two quarters, so up through June, GDP shrank by 1.6 and 0.9% real. So, but you don't hear it, and it's weird because we also only have a 3.5% unemployment rate, which but not every recession is the Great Recession or Depression either. But you don't hear anything, and I don't know. Is it political? It's an election year, So I'm just kind of surprised that suddenly it's very more subjective, and this is what they say is the significant, widespread, and prolonged downturn in economic activity. And that's usually been defined as 2 quarters of negative GDP, which we've already hit. And at least the news said in July, it looks like demand was even lower, just because the inflation's been hurting us. But so by what I've understood as the definition of recession, we're in it. But how severe it's going to be and what the impacts, that's yet to be told. But how do you go ahead,
Alan? I was just going to say, I was listening to a podcast that was talking about this, and the point that they made was, GDP is still a positive number, for the US, but it has shrunk quarter over quarter. But it's also, less than the current inflation percent or whatever is still greater than the GDP output too. So when inflation starts outweighing, and that's what your GDP,
your economic
stuff,
growth.
or it's kind of the inverse there. But
right, absolutely. And there's I heard a good Scott. I'm glad you said that, because it's something similar. Somebody pointed out, like, a recession is 2 consecutive quarters of decline in GDP growth. That's from the high mark we were just at. I mean, the idea that you can always continue to grow seems kind of ridiculous. So from our very highest growth, GDP ever, it's dropped down a little bit. Okay,
exactly.
Is it that bad? No, probably not. So, and I would say I would have expected much, worse when COVID hit, when there was like a 30% decline in the economy. But that's when the Fed, they pumped all the money in, all the stimulus, everything else, and people didn't spend it. Actually, they saved it. and that caused it and invested. But there wasn't the demand causing the inflation at the time. And so the Fed is normal, overdoes it and does too much stimulus. And then now we're seeing the after effects of that. But we'll see. How to protect against recession. Not talking about investing your money, but this is just what I say are the most important things to do. The emergency fund. I was in the military. I hardly had any emergency fund because I had the most stable job. You know what I mean? And I knew it was pay was not going to go down, and it was, so I wasn't as worried about needing 6 months of an emergency fund. But what they've shown is that in a tough recession, the average time it takes somebody to get a new job if they've been laid off is like 181 days. So a 6 month emergency fund is probably the best. If you're married and have both of you are working, maybe you could cut it down a little bit because the likelihood of both losing a job is a little less. But really, I think you want that 3 to 6 months. Yes, it's not making good money, and especially in this inflationary environment. But these, we'll get into it. Bad economic news is an extrovert. When a recession happens, the market gets crushed. Housing market has issues. Everything happens at the same time. So if you suddenly, when you need cash, you don't want to be selling stocks that are just down 20, 40%. So while it's boring and doesn't make a lot of money, cash is king, and you do want to have that emergency fund. Get rid of consumer debt, of course. Hopefully people here don't have any consumer debt. Credit cards, use them for their points and stuff, but if you keep it balanced, then just quit using them. Be the best at your job. And this is one thing, we'll get into investing later. Like, don't spend your time trying to figure out the best, absolutely best portfolio, best mutual fund, this or that. Just stick with the basics, which we'll get into, keeping it simple. And then use your time to improve your skills or get a different, skill, so that you're more marketable. And hopefully, even developing multiple streams of income. Any questions there? Any other thoughts? Any other ideas people have that they think is also, something good to add on here? Okay, bear market. We hit it in this year already. It's actually recovered like about 10% in the last since July. But when assets, typically they use the S&P 500, which is, for those of you that don't know, that's the index of the roughly 500 largest companies in the U.S. And that's usually when they talk about the market, that's kind of what they're using as an example of. Even though the market consists of all the companies, both international and U.S. But bear markets are scary. You see your net worth just getting demolished very rapidly, and too often we are very emotional and we're completely irrational. Has anybody read the book Predictably Irrational? It's very good, but it's almost embarrassing when you read it about how we are, because all of us will have to admit that we're like that when you read the book, and how emotions play with our decisions, where we can think of ourselves as rational beings, but we're not at all. And then with every bear market, it's always this idea that it's different this time. And this time, what I was thinking is, wait, this is different because bonds went down significantly as well. That's not different. That's just has to do with interest rates. But they still didn't go down typically quite as much as stock. But there's the market wouldn't plunge if there wasn't fear that something was different. And that's why these things happen in the first place. So the best thing to do is do nothing most often. Or if you can, we'll go into some specifics that what you can actually do to improve your situation and take advantage, maybe make lemonade out of lemons. But yeah, I'd shown this on the last chart or the last discussion, just as when we were talking about ESPP and RSUs, just at the very end, just because I knew it was on people's mind. But I mean, there's a lot of things. There's a lot of issues, going on. And does it make you scared? Absolutely. But that's when, this Warren Buffett, that's his quote at the bottom of, be fearful when others are greedy and greedy when others are fearful. When the market's tanking, if you can, that's the time to buy more. Put, get your dollar cost averaging in, and you never know when it's going to suddenly go up. Why did it suddenly gain 10% in the last month? Like, did the economy suddenly do backflips and everything's better? No. So you never know, and usually it picks up very rapidly, and you don't want to miss those gains. So staying in the market, and if you can, taking advantage of it and putting more in when it's down is the best thing you can do. Okay, so bonds. Why did bonds go down? That's supposed to be your safe bet, right? Well, bonds have to do with prices, which is what dropped, have to do with interest rates. Interest rates had completely bottomed out, right? Fed went to a zero rate when COVID happened. Well, let's say, so for example, hopefully this makes sense. On the right though, when say in 2020, you bought a bond and interest rates are so low, companies are able to use, let's say 2% coupon rate, 2% interest rate that they're offering on bond. Well, when interest rates go up and all of a sudden people have new bonds they're issuing at 5%, say, who the hell wants your 2% bond if you tried to sell it? So obviously, as that interest rate goes up, people are like, screw your 2% bond, that price goes way down to sell it. So does that make sense? Longer term, you're gonna get more yield, which I'm glad. I think the interest rates have been so low for so long that it's forced many people probably close to retirement, baby boomers, to get a little more risky just to get some more yield. So they have a higher percentage in stock than they would have before when they could get a decent percentage on bonds. So I think we're just getting really kind of back to what makes sense. But does anybody have any questions on that? Did that make sense about the bond teeter-totter? And then the duration there. So if you've got a 30-year bond, it's a much longer duration. It can have a much bigger swing when those interest rates change. Short-term bonds like the 1 to 3, there's not much change. It's almost like a cash equivalent. So those fluctuations also depend on what kind of short-term, intermediate, or long-term bonds. Does that make sense? It's the first time I heard about bond teeter-totter. I was kind of confused, but
this is just for buying direct bonds, right? Bond funds and other things have a lot of other kind of
that's true, but bond funds, usually, like if you looked at Vanguard's like total bond market index fund, it got crushed as well this year because this impacts they're constantly buying, and they're impacted by these as well. So even those bonds, the value of those bonds went down as well. But now the yields are going up and the durations are actually going up as well. Somebody actually at Bogle, Joe, have you ever listened to that Boglehead?
Yeah.
So that podcast, they actually recently had the head of Vanguard's total bond market index fund on it, and they were talking about bonds. It was good. So that might be something you want to check out. But even those bond funds are impacted, and actually they're impacted more than typically than other bonds. Like if you just bought a individual bond, which I'm not recommending at all, but if you bought an individual bond, nothing's going to change from that initial coupon rate that you got. It'll keep paying that same interest every 6 months or year. And then if you held it to maturity, you'd get the whole principal back. So if you held it to maturity, it wouldn't make any impact. But the fact is, people are buying and selling these things, and that's why the prices fluctuate significantly on the bonds with interest rates. Does that make sense?
Mm-hmm. Yeah.
Okay. Any other questions here? And this is where I bonds are not impacted by that. That's why I said they're protected from interest rate risk. they're bottomed at 0, that fixed rate. So they could, if there's no inflation, it just doesn't change. But you can't go negative where you can with bonds, and PIP, our Treasury inflation protected securities, which were minus 6.37% year to date. So, but hopefully that makes sense. Okay. Yeah. Okay. I do think interest rates were overdue to hike up. So, okay, young investors, most of you all here should all love bear markets. Why is that? So here I just showed, this is, you know, the S&P 500 inflation adjusted returns from 1926 until October 2019. And you see all those, like I like to say investing in the market is you're walking up a mountain with a yo-yo, and it's going to be volatile, it's going to be scary at times, but it's always moving up long term. And now if you can be buying, my cursor is not showing up. If you can be buying though on these dips, you're just buying much cheaper. And then it's gonna past performance is no prediction of future expected, future result. But do you really think in 20 years the market's going to be worse than it is now? Do you think we're not going to continue to innovate and companies are going to continue to make profit? I'm optimistic. And so always be buying. Keep dollar cost averaging, and if you can, shove more in. That's what I try to do. When I saw the market dipping, I'm a little bit older than some of you, so I start having more some bonds in I shifted back to all equities again, 100% for 401k, all equities when I saw the market dumping. And then like Matt, some of us also have a TSP account. When it dropped about 20%, well, I moved some out of some of the bond funds I had back into the equity funds, rebalanced, so that I could take advantage and put more money into the equities, and then hopefully ride that growth back up, hopefully sooner than later. But I'm not worried about it long term, and that's what I want to do. Keep it simple. Like I said, don't spend all sorts of time trying to figure out the best exact mutual fund. Just keep it simple. Buy low cost broad-based index funds, total US stock market, small cap value fund, some international stock market index fund. Now you've got the whole world covered, and then a little bit of emerging markets, so those growing countries. That's all you need to do in the accumulation phase, and shove as much as you can in. When you're young, the savings rate is more important. We've talked about this before, than your rate of return. So instead of spending your time trying to figure out how to try to beat the market, which you won't do, just buy the whole market, take advantage of it, and then work on other things that'll help you build more money, in salary, et cetera, that you can even invest more. Any questions there? Nope. Okay, now, and this I also showed the last discussion, but this just shows how short duration bear markets typically are. On average, it takes 19 months to bounce back. Lately, it's been shorter, and that's a lot of times been because of what the Fed's been doing. But look at how much these bear market returns, these dips are compared to the incredible bull market runs, and how much gain you get. Average bull market is about 9 years, and nearly 500% total cumulative gain. Whereas a bear market typically loses 40%. Boy, that hurts. When it happens, it's scary, but you don't really lose anything if you haven't sold anything. It's just don't look at the news, don't look at your accounts if that bothers you, and just keep funneling money in, and you'll be happy long term. Any questions here? I think we always got to take this into perspective when we see a down market. Okay, here's where it's scary for people that are getting close to retirement. Has anybody heard of sequence of return risks? Okay, well, in general, as it's defined right up there. But right as somebody's getting ready to retire or close to it, suddenly the market dumps. And if they don't have a balanced portfolio where you've got short-term money and you don't have to sell out your equities, it could significantly and irreparably damage your long-term retirement accounts. And this graph just goes into it. This assumed a $60,000 per year annual withdrawal rate, which is pretty ridiculous, I think, on a $1 million portfolio. That's a 6% withdrawal rate, which is higher than expected anyway, but it still shows the point. But these different returns, so if you have negative returns early as you're starting to withdraw to draw down your account, that's unrecoverable. Once you've sold it and used it, it's gone. You don't have time, like younger people, to let that regain and go back to positive returns. So you can more rapidly deplete your money, and that's why you probably need, your short, long, medium, and long-term buckets. Some people are, more conservative than others, but usually people talk about potentially having up to 3 years in cash equivalents, 1 to 3 years of cash equivalents as you're getting near retirement, so that if you hit a time right now where the market's down, you don't have to sell your equities and you can give it time to recover, and you have all the short-term money you're not losing any value on to get you through the rough patches. After a few years, like 5 years, that doesn't matter. If you have normal market returns during that time, you should be pretty golden. Any questions there? Okay, and these are all kind of interrelated, like talking about what to do with inflation, what to do with recessions, what to do when the economy, bear market and goes to hell. I mean, the first thing is, like I said, a lot of times taking no action is better than anything. Just don't take a deep breath and just get away from the noise. I put an asterisk there because we kind of talked about it too last time on ESPP and RFUs, where in general you're not going to lose your money if you have it invested diversified. If you have it all concentrated in one company, yes, you could be very screwed. When the Great Recession happened, I went back to my hometown, and I was in the military at the time, and most people I worked with and knew were military, and none of us were really impacted. And heck, I was deployed anyway, so I didn't see anybody. But going back to hometown, holy crap! I saw how the devastation people felt. And one person worked at a local bank. Feds came in, shut it down, had never diversified out of that money, and all the stock they had was in the company. That company went under. $750,000 worth of net worth gone in one day. Crazy. Like, unfortunately, we're not at a company like that, but it just goes into the importance of diversification. And then an investor policy statement. That's what will really help you when times are bad, reviewing that. And you write that when times are good. And you follow that you don't make stupid moves and sell out when the market at the bottom, and then not know when to come back in, and you just wasted all sorts of growth. Any other thoughts here or questions? Okay, here we talked about making lemonade out of lemons, especially for people getting close to retirement. One good thing about a dip in the market is you can do Roth conversions and get a lot more percentage of your net worth over into tax-free life forever account, the Roth IRA, in a shorter time frame. So I just gave an example. You can see up there, and I showed the different tax brackets, and I was assuming they were using the current 22%, but you could could have moved a large fraction over and keep it the same tax rate, and then when the market recovers, you have all that tax-free, all that gain now is tax-free forever. So that's one of the best things you can do, I think, especially for people getting close, or even younger people. If you've only done traditional on your 401k, you could take advantage and move that. Like our 401k, we can do that. We can move, convert traditional to Roth in our 401k. We're gonna have to pay taxes on it that year, but it's an option. We can do it. And when the market dips like that, though, you move a much larger fraction, relatively speaking, and save on taxes. Make sense? Okay, accumulation versus drawdown. Accumulation, most young people, you're in there. When you're getting ready to draw down, that's when you're retiring. And in my thoughts in general, when you're young, go 100% equities if you can handle the roller coaster. If you can't, if you're going to sell out, then go a little more conservative. But you're going to do best by being all stock early on. Or you could maybe even do 90-10, 80-20, where you wouldn't lose too much gain, and you'd still, you'd feel a little bit better when the market dips. So, but when in drawdown, that's a different animal. And there's forever they've talked about a 60-40 portfolio, but with bonds, the yields being so low, it hasn't been too great. And I put some resources down here though, but developing a real risk parity portfolio is the way to go. You're going to sacrifice some rate of return, but you've already made it. So don't go too risky. But you'll gain like 1 to 2% safe withdrawal rate. Think about an increase. If you had a 4% safe withdrawal rate that you could raise to a 6% safe withdrawal rate, that's 50% additional money you could spend each year. It's something to look at, but it's definitely, that's something when you're within 5 years probably of retiring, something to really start evaluating and maybe start moving things around to where you have non-correlated assets. And let's see. Oh, here's just questions from Slack. These were Shama's questions. Can you take a look? Did we discuss this enough? You guys have any specific questions? But she unfortunately couldn't attend. But I think we talked about most of these already. And then she also asked about Roth conversion. So this I want to touch on for people. Matt asked about, is this the correct process? And using zero funded IRAs for yearly deposit. You can't use just zero funded. If you're going to do a backdoor Roth IRA, the IRS aggregates all of your traditional IRAs that you haven't paid tax on. So you can't just open up one, deposit money, then backdoor it into a Roth and think you're all going to be good because there was no other money in that account. The IRS takes all those and then it does a pro rata rule, which we've talked about. Convert the entire amount, keep the amount open. Convert the entire amount, meaning if only you have that money that's non-deductible IRA contribution, move that into the Roth. But you can't take a tax deduction and a Roth conversion. It doesn't work that way. It's a non-deductible contribution into a traditional IRA, and then you convert that to a Roth and invest it. But this is what you do when you're over the income limit for a Roth, which we'll quickly go into. This, if you're single and you make over 144K, that's when you can't contribute directly to a Roth. If you're below that, then just contribute directly. Don't even think about backdoor. Just go right into the Roth. And then say with married, 214K. So for California, pretty low, especially for married income limits. But that's how you backdoor. But has to be a non-deductible contribution. I say, convert that whole amount, and I like to do it all at once. So instead of having to do this every, say, dollar cost averaging every month, nope. In January, I shove the entire year's money into the market, and then I don't have to worry about backdooring every month. 2, I've got time in the market. So time in the market is more important than timing the market. So that'll typically help you making 8 out of 10 years. You'll do better by even doing that, but it's just simpler for me. And then why this is the whole pro rata rule that I was hoping to explain, that this was what the question was. If you contribute non-deductible $6,000 though into a traditional IRA, but you already had $94,000 of untaxed money, in any IRAs that you have, and then you try to convert that 6,000, the IRS sees 94% of that as taxable. So you're going to get taxed on 94% of that $6,000. So you really need to have no money in traditional IRAs to make a backdoor Roth IRA conversion make sense. What you can do is you can roll your traditional IRAs into the 401k, and our 401k allows that, and then you could do the backdoor if you're comfortable with doing that. If the backdoor was that important, you could just do more Roth 401k contributions. We can get too much into it, but okay. Any? I know we're already run over. Any questions? Here? I'll quickly possible topics to explore. You guys have any questions for me? Whoop, see a chat. I missed. Whoop. Okay. I can handle my cursor. Okay. Oh, Sandra. Okay, great. Okay, and anybody, as you know, we've got recordings. If you want, that's where the recordings are located, and then there's where the slide deck. I need to obviously say once this compiles after we stop recording, I'll post that. It'll probably be later this afternoon, and then the slide deck still will be there as well. So, any other questions? Okay, if not, well, thank you for your time, and hope you found some of that useful at least.
Yeah, thanks, Alan.
Thanks, Scott.
Thank you.
Thank you, Alan.
You're welcome.